It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Oil steadies after the biggest one-day jump in almost a year on concerns Israel may decide to strike Iranian crude facilities. But prices still on course for the biggest weekly gain since early 2023. Asian stocks and bonds trading in tight ranges as investors focus on the upcoming U.S. jobs data for fresh clues on the Fed's rate path. Also ahead, the EU set to vote today on a massive tariff increase on Chinese electric vehicles. Germany doesn't want it, and Spain wants to talk it out with Beijing. And we speak exclusively to Nandini Perumal, chairperson of Perumal Pharma, about her firm's global expansion plans and challenges faced by the industry in India. Well, comments by President Biden helping to trigger a further surge in oil prices already on the rise over concern about continued conflict in the Middle East. Speaking to reporters at the White House, he was asked if the U.S. would back an Israeli attack on Iran's oil facilities.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion.
A U.S. official later clarified that the administration was still in talks with Israel and believed no decision had been taken yet. Biden's comment came after a group of 7 leaders urged restraint this week against an uncontrolled escalation in the Middle East. And both Brent as well as WTI crude have sought this week ongoing concerns that supplies from the Middle East may be disrupted. The region accounts for about a third of the world's total supply. Let's get the latest on the situation in the Middle East with news desk editor Jill Decies. Jill, what do we know right now?
Yes, Haswell, I think it's really about those Biden comments at the moment that's, what triggered this market reaction in terms of oil. There's a lot of attention, obviously, right now on what the U.S. as an ally to Israel and what the group of 7 are ultimately doing to try to control or encourage Israel to de-escalate tensions within the region. These comments from Biden came, obviously, about a day after we did hear from him on the subject of whether the U.S. would support Israel if it targeted nuclear facilities in Iran. That he was obviously much stronger in, vehemently asserting that the U.S. would not support that issue. But there's a whole broad range of potential retaliation measures that Israel could take against Iran. Obviously, the idea that it would target oil-related facilities or other energy facilities is on that spectrum, not as extreme as a nuclear strike, but certain attacks on nuclear facilities, rather. But certainly something that kind of enters the conversation here. The fact that you've got the president seemingly acknowledged, President Biden, that is, seemingly acknowledged that attacking oil facilities is at least on the discussion table is something that's creating a lot of uncertainty as we head into the weekend here.
Jill, some suggesting that it is quote rape time in the Middle East. I mean, where are we with this conflict?
Well, Haas, I'll tell you, it's certainly a much more dramatic picture of conflict right now than it was even just a few months ago. I mean, back in April, when you did see, strikes on Israel that it did retaliate against with, some targeted attacks that involved very few fatalities. Now we're seeing a much more dramatic escalation of tensions in the region. Just over the last few weeks, we've seen Israel, in particular, go after and attack Hezbollah targets in Lebanon, Iran-backed militia targets in Lebanon. We saw the assassination of Hezbollah's leader. We've seen other targeted strikes there. That does indicate that there's obviously, we saw a ground incursion into Lebanon earlier this week. This does obviously indicate that tensions are ratcheting up here. What this now comes down to is how much further Israel is going to take this and what it is that the U.S. and other G7 nations would try to be hoping to do in order to de-escalate things to prevent this from turning into an all-out war in the Middle East.
Exactly it. G7 nations calling for the regional players to exercise restraint, to act responsibly. The thing is, how much bite do they have?
That's a great question, Haas. And look, the issue here is that as we've seen, as conflict has developed in the Middle East over the last year, is that there hasn't been a ton of success that the U.S., the rest of the G7 has really had in terms of getting Israel to kind of back down off of broad conflict. We've obviously not seen a ceasefire in Gaza, for example. But ultimately, we'll have to see whether or not the attempts by the G7 to try to prevent things from escalating into all-out war are actually successful. But as we have seen with these attacks over the last week, we've certainly seen just some attacks over the last 24 hours that have resulted in at least I believe around 9 fatalities in Lebanon. This conflict is and does remain deadly and does remain very concerning as we head into this weekend.
A developing story still. News desk editor Jill Deeses. We thank you so much for that. Let's get to our next guest for more on oil markets. Sarah Vakshuri is founder and president at SVB Energy International. Sarah, taking a look at where oil is right now, on track for a weekly gain of about 8%, approaching Brent approaching $78 a barrel. I'm just wondering, how are you reading into oil prices right now? Is this short covering or is it more than that?
Well, obviously, this is a short covering today because of all the sentiments that we are seeing. But depending on what is going to happen in the next few days and what would be Israel's response to Iran's attack, we're going to see and know more that if the prices are going to be at this range for longer or no.
So from your view, how much of that potential attack on Iran's energy facilities has been priced in already?
Oh, well, a lot of that we would say, again, like it depends that where exactly is going to be attacked, what would be Iran's reaction to that, or the retaliation spirals that this could spike. So we cannot exactly say that how much of it is priced in, but definitely the market is worried that energy facilities in Iran is going to be targeted. And given the fact that Iran's proxies have been weakened in the region, and also Iran's missiles, as we've seen in the last 2 attempts, could not really successfully reach directly the Israel's. This increases the potentials of energy facilities being a target for the conflict between two. But is this going to be a large scale? At this point, we have to also consider that even Israel is an importer of oil. The whole world cannot tolerate a large spike of oil prices. But it's also not just about oil. You know, we have facilities that are, or energy routes that could target other sources of energy, like natural gas. And also oil doesn't have a significant share as it had back in 70s in terms of our global energy system. So there is a lot to consider, but I would say today's prices are mostly a hype and uncertainty in the market, and we shall wait and see that where exactly this retaliation going to happen.
Sarah, put the supply side in perspective for us. We have, of course, a swell in U.S. supplies, but we're also getting optimism in China. Perhaps, you know, the stimulus recently would boost demand from China. In terms of supply, where are we with that?
This is very interesting because it seems that the market is heavily impacted by the sentiments, because just a few days before Iran's attack, we had all these media sources, even I would say vague sources, that they would swing the sentiments of the market to completely opposite side of where we are today, into the fact that no China, highlighting the low demand, potential of oversupply. So it seems that most of these price fluctuations are not really based on the market fundamentals, rather than the sentiments, what is coming out of media and how it's really impacting the market. But definitely, as we see, market is heavily dealing with uncertainty on both sides of supply and demand, because we see that simply by the news headlines, it's fluctuating to both opposite sides.
When it comes to the options market, of course, we're hearing murmurings of $100 a barrel. What would it take for oil to get to 100?
If you're talking about geopolitical risk premium, well, we had different incidents. For instance, what happened at the attack back in 2019 on Saudi energy facilities, we did not see such a huge spike in the oil as it was expected, or it happened back in 70s. Again, it depends on the scale of attack. I do not think that, for instance, we're going to immediately see a huge targets like Strait of Hormuz or Iran's export facilities, because that is going to create a havoc in the market, is going to have huge consequences. Iran is not going to stay quiet. Definitely, they're going to retaliate. So I think it depends on if there's going to be a target among the energy facilities, depends on the scale, the volume, and how fast and how much oil is going to be taken out of the market, how easily is going to be replaceable. But also you have to think of spare capacity. Current OPEC Plus cuts have left the market with a large cushion and spare capacity. Also now we have another sources of supply like United States that are passing through different routes. So overall, I think that even Israel or players in the market, countries are rational. This might, even if it's the facility is going to be attacked, definitely we cannot predict for sure, but I do not see it's going to have a huge impact on the oil supplies. But if it's going to have, we shall wait and see how much of oil is going to be taken out and for how long,
Right.
and if it's as any other sources to substitute that.
OPEC response would be key as well. As of now, it's yet to decide on what it will do in December. What do you see OPEC doing then?
Well, this is actually very interesting because if we look at, again, going back to, for instance, Russia-Ukraine incident, OPEC has always been very cautious regarding its decisions, the statements that the OPEC members have been issuing. And what is very important is that OPEC does not react to market sentiments, do not intensify those sentiments, rather decides based on actual fundamentals of the market. So if there is actual changes in the market's fundamentals, in the case of geopolitical risk, if there is a shortage of supply, definitely we could expect that OPEC would have decisions to be made. But just because of market sentiments or like media headlines or how market is worried or the psychology of the market, this is not something that has been, or at least before previously, pushed OPEC to come into making decisions for market.
Sarah, like we said, there's still so much uncertainty, but could you just look into the crystal ball? If you were to hazard a guess, where do you see oil prices by year end?
This is a very interesting question because, again, I usually don't like to talk about the prices because, as I see already, there's a lot of hype and sentiments in a market that within a week prices move to different complete directions. I think the algorithms are playing a big role. They're looking at keywords that are being published by media or said by the officials and experts. So I think we should all be very careful by the words and the news. Everything should be really accurate. So I do not tend to look into the prices, but it all depends. If you're going to have a huge geopolitical actual risk in the market that is going to take supplies from the market, or if the sentiment by the end of the year is more heavily toward the demand side and uncertainties over demand.
Sarah, thank you for your insights today. Sarah Bakshuri, founder and president at SVB Energy International. Of course, oil, Brent, trading at close to $78 a barrel. In the broader market, let's take a look where Asia is trading right now, still managing gains despite those escalating tensions in the Middle East, the possibility Israel could strike Iran's energy facilities. Also, of course, we're keeping a watch on the much anticipated U.S. unemployment data. The MSCI HPEC index up by 0.5% at pretty much at session highs, and we have the Hang Seng trading up by 2.5%. HSTEC in particular, quite a performance today, higher by 4.5%. On the back of that, let's take a look where we are in terms of those chip stocks in Hong Kong. SMIC in particular having a swell day. It is up by more than 20%. Shanghai Fudan Microelectronic also surging 19%. Hua Hong Semiconductor 17.8% at this point in time. We'll get you some of those reasons perhaps driving those chip makers in Hong Kong up at this point in time. Now, still ahead this hour, an exclusive conversation with the chair of Indian drug maker Piramal Pharma. We'll discuss their growth plans, especially in the U.S. Keep it here with us. This is Bloomberg. Markets smiling, a lot of factors out there, the intensifying conflict in the Middle East, of course, the unemployment data coming out of the U.S. Today as well. S&P futures pretty flat, or rather up by about 1/10 of 1% right now. Dollar index is flat. We're keeping an eye on the Japanese yen, 146.43. Some say perhaps it could get to 150 on the back of those comments from the Prime Minister saying, you know what, perhaps it is not time to raise rates just yet. Not this year, perhaps. Some say maybe in January. Gold futures at 26.82, up about 1/10 of 1%. Again, we're keeping an eye on Brent crude inching ever closer to that $78 a barrel on the back of intensifying conflict in the Middle East. Let's bring in our first guest, Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC. There's so many factors out there. You got to imagine what's front and center.
Well, obviously, the Middle East tensions seems to be escalating, and that's keeping markets a little bit on edge. But I think the key for today really would be the non-farm payrolls data out tonight. There is a very wide range of forecasts in the market, anywhere from 70 to 220,000, but consensus is hovering around 150. I think if the number comes in about 150, 165, generally markets not going to react too much to that. But any surprises on either side, well, we could see some recalibration of the near-term Fed rate cut expectations.
It is an important data. It is closely watched. Dudley has something to say about the economy. Let's take a listen to what he's got to say.
The Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that very, that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
So he says the U.S. economy not in the clear just yet.
Well, that's not saying too much. I mean, everyone who has been calling for a U.S. recession for the past 9 months have been disappointed, right? The services ISM tells you that really the U.S. economy is not falling off the cliff, but the employment gauge in the services index does tell you that it's in contraction. And now the Fed is prioritizing the labor market conditions. So I think apart from the non-farm payroll numbers, we also have to look at the unemployment rate, because they've got unemployment rate forecast at 4.4% for this year and next year. So if you get an upside surprise, a big jump, that could change the story again.
Quite interesting. Goolsbee also weighed in on the topic, saying that rates will have to come down a lot, significantly over the next year.
Well, it depends on what's the definition of a lot, because markets already priced in, about 60 basis points more for the remaining 2 meetings of this year, and another 120 or so next year as well. So by any means, plus the 50 that's already done, you're looking at, more in the range of like 200 plus basis points. That is a lot.
What the Fed does has ripple effects, especially for the BOJ right now, which is considering what to do. We have the promises saying, you know what, it's not time yet for another rate hike, but all eyes on the Fed, where the BOJ is concerned as well. It wants to ensure that there is a soft landing before it does anything.
Yeah, I think for Ishiba, I mean, we have to take some of his comments in the context that he has elections coming up end of the month, right? So he does want, market not to go too hawkish on the BOJ. He wants a boost for the equity market and stuff like that. So I think market may look past some of the comments, but the yen has obviously reacted. So, some market players are looking at 150 on the top side, but generally I think it's still going to be around 145 to 150 range for dollar yen in the short term. But in the overall scheme of things, the BOJ is at very, very low rates. They still have a long way to go to normalize rates.
The thing is, some say that the BOJ could be headed the Fed way, where it responded too slow, perhaps, like back in 2021. What's the risk of that?
Well, if you look at the BOJ's track record, it's a little bit...
Not a very good track record, actually.
Yeah, so it's a question of, backed in the corner, they have to do something. It's true that they started normalizing rates when the entire global monetary policy is going the other way. So they're already caught on the back foot, right? So it's not an easy dilemma for them.
In terms of the FX space, you talked about your projections for the yen. Some say perhaps it will get to 150.
Well, it may. I mean, if the economic surprises continue to surprise on the upside, I mean, you're already starting to see a virtuous cycle between wages and also price expectations. And I think, if that continues to progress, it is very conceivable that the BOJ will have to continue to normalize rates.
Given expectations for where the yen is headed, what is the best play when it comes to the yen? Some say, you can expect that carry trade to come back, and that's the way to look at the currency.
Well, I think it's going to be a very short-term tactical play because, like I say, the longer-term story is that if wages and inflation continues to progress in the Japanese economy, the BOJ will continue to normalize rates, and they are doing so at fairly baby steps.
Okay. So we've done the US, we've done the BOJ. It's also about China. We've seen such a massive run-up in the markets in Chinese assets, and something we've not, I guess, which has taken the markets by surprise. What do you make of the reaction in the market so far?
Well, market reactions has been very positive. I think there is a lot of expectations that maybe this time it's going to be different. I think in terms of the response, the rapid fire kind of pace is of course encouraging, and I think they basically have to keep up the momentum. But what's different this time is that not just on the monetary policy side, but also on the fiscal side, they're starting to do more to try and lift the animal spirits for the Chinese consumers. So if they can stabilize the correction in the property market, they can get equity prices on this upward trend, then that would help to reverse some of the negative wealth effects that we've been seeing. So hopefully Chinese consumers will have improved appetite to spend, and that's really the crux of the problem.
But still more measures expected.
I think definitely so.
What kind of measures would you like to see?
Well, I think on the demand side, they have started, relaxing a lot more of the restrictions on the property side. Hopefully that will help. And then plus they have, provided funding for the local governments to buy back more of the unsold inventories in order to provide public housing. So that should show up a little bit of the demand. And then on the equity side as well, we've seen a fair bit of inflows coming into the Chinese equity markets. So they really need to keep up this momentum.
The thing is, Selina, we have been here before. There's been false alarm. I mean, is there reason to be, I guess, to take measures to perhaps protect your investments in China?
I think it's a question of your time horizon. In the short term, obviously, it's run up quite a fair bit. So it really depends on what is your slightly more medium-term horizon. If you are in a camp that you believe growth prognosis in China is going to continue to be on a slowing trend structurally because of the tensions from the US and Europe over specific industries, whether it's EVs or solar panels or chips. And then you think about the population dynamics in China itself is going to be structurally aging, then obviously that means that you will kind of like dampen expectations for overall growth.
Okay.
But that doesn't mean that within China there are no pockets of opportunity.
All right, Selina, thank you so much for that. Selina Ling, OCBC. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, here's a look at Korea Zinc. The stock surging this morning above MBK's partner's bid price as it seeks to take control of the world's biggest smelter. That's after a Yonhap report saying MBK and Yongpun are likely to boost their already sweetened offer. Korea Zinc currently up by almost 7%. In Hong Kong, we're keeping an eye on those chip makers having quite a cool day right now. Take a look at that rally. SMIC surging more than 20% along with Shanghai Fudan Microelectronics as well as Hua Hong Semiconductors. Chip makers there surging pretty much in line with China tech stocks in particular as well. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, looks like it's no stopping the Hang Seng. It continues to rally. The Hang Seng Index extending the gains to more than 2% right now after that two-day correction. Asia's tech up by more than 4%, and China 8 shares up by 2.3%. Worth noting, Hong Kong's market cap back above that $6 trillion mark. HSBC too now has an overweight onshore Chinese stocks. Chinese stocks, of course, higher about 30% since that low, which we saw in September. Hong Kong stocks set for a third week of gains. Now, skepticism is growing over the biggest stock rally in China in nearly 2 decades. GQG's Rajiv Jain sees the recent surge as fleeting, saying it echoes the so-called reopening trade in late 2022, which fizzled out within just a few months. He adds, if the rally goes on without us, that is fine. Nomura Holdings' Ting Lu also warns the stock boom could turn to bust, with the Chinese economy on a much weaker footing now than before the pandemic. He says, while it's okay to indulge in the rally for now, a more sober assessment may be required from investors later on. For more, let's bring in Bloomberg M-Live strategist Mary Nicola. So some divergence there, but you know what? Some say, like we heard from Selena Ling earlier on, it is slightly different this time around.
It is, and you can feel it in terms of just the way policy was coordinated on both the monetary policy side and the fiscal side. There was the fact that they put this stabilization fund on equity markets. So there's a few little tidbits that really show that they're serious this time, almost akin to like the whatever it takes moment that we saw from Draghi back during the European sovereign debt crisis. And of course, you know, what's going to tell is how time goes by in terms of what we get over the holiday break in terms of consumer spending, consumer sentiment. How has that shifted? Because that will be absolutely critical to really get this stock market rally going.
But along the way, there will be correction. It won't be a straight line up. Fair to say that.
Absolutely. If you had a straight line up, you'd be really worried about it, to be fair. So you would want this correction. And I think, and I sympathize with people who are saying that it's akin to the reopening trade, because the reopening after China reopened, everyone was excited because we were going to get another reopening from this time from China when we saw the reopening happen globally and what it did to stocks. So there is a little bit of you know, concern in terms of and skepticism because we didn't see it with the reopening. So why would we see it this time around?
So trepidation when it comes to the Chinese market, pretty expected. What's also expected, a trepidation when it comes to developments in the Middle East. Yet, when you take a look at the markets, it ain't too shabby. I mean, we're managing gains here in Asia.
Yeah, I think the main focus for what's happening in Asia in the Middle East will be on oil. I think that's where you feel the heat in the markets and probably the dollar, right? That's where you're going to play it because there's still so much uncertainty surrounding it in terms of what Israel will do next. Nobody knows. And so when you have all these geopolitical tensions lingering, it's going to weigh on the two things that it is going to be affected the most, essentially.
We've been talking about how oil has surged, but it's still Brent at $78 a barrel. That's unlikely to feed into inflation concerns, not just yet.
Yeah, because you also have to, we have to think about the demand side of the equation. And the demand side we know was slumping for quite some time. Then in addition to the fact that you had Saudi saying that they were going to abandon their $100 target. So that in and of itself was an indication that supply is about to increase when demand wasn't doing very well. So the supply demand dynamic still doesn't suggest, unless let's say you see a blockage of like the Strait of Hormuz or something to that escalation and that elevation, then you could see oil prices creeping higher. But for now, it's still that demand side that's going to weigh on it.
All right, Mary, thank you for that. Bloomberg M-Live strategist Mary Nicola there. Now, EU member states are preparing to vote Friday on imposing tariffs as high as 45% on imported EVs made in China. Let's bring in China correspondent Min Min Lo for more. Min Min, how could the vote go?
Yeah, you know, negotiations had been intense up until this point. Chinese Foreign Commerce Minister Wang Wentao was in Europe some time back, and he had vowed to keep these negotiations going until the very last minute. And it's quite a split vote going on. We know that Germany, Spain, these are two countries that have publicly expressed their opposition to those tariffs. The CEOs of Mercedes, Volkswagen as well, putting pressure on the German government to be very careful with these tariffs because they are afraid afraid of retaliation from China. There had been hints that Beijing could retaliate with these tariffs on vehicles with large engines, and these German car makers, they still make about a third of their sales from China. But European officials seem to be quite confident that they do have the number of votes to push this through. Reuters reporting that Poland, Italy, France, Greece are likely to vote in favor. That may be enough to put that proposal through. And the bar is very, very high because China needs a qualified majority of 15 member states, making up 65% of the EU's population, to oppose this proposal in order to avert that tariff. And so far, we have never seen any EU trade measure being overturned in this way before.
If it is a yes vote, how might this play out? What might the impact be?
Yeah, so if it's a yes vote, then these tariffs, additional tariffs as high as 35% on some companies, would kick in November. And we know that according to some estimates, it could cut Chinese exports of EVs to Europe by as much as 25%. Although there are some analysts who are a bit more optimistic, just looking at the estimates of sales in the first 4 months of this year for companies like BYD, SAIC, they're seeing sales to Europe make up only 1 to 3% of the overall sales. So maybe these companies can still be quite resilient here, especially given they had a lot of time to prepare for this moment. They have been scouting for locations to set up plants in the EU to bypass some of these tariffs. Chery, for example, looking to open up a plant in Spain. BYD looking at Turkey as a potential place as well. And you have these companies also actively looking to expand their markets to other parts of the world, to Southeast Asia, for example. But of course, the greater fear is not just the fallout within the EV sector, but whether it would broaden out to a bigger kind of tit-for-tat trade war between the EU and China, especially if China retaliates in other sectors, like agricultural goods, aviation, for example.
And that's the last thing the world needs right now. Bloomberg's China correspondent Min Lo, thank you. Now, still to come on the show, our exclusive with Piramal Pharma chairperson Nandini Piramal. We'll discuss global growth opportunities for the Indian drug makers amid rising US-China tensions. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus, and here's a look at Indian markets just ahead of the open in just under 7 minutes. Of course, Indian markets have been under pressure. It is expected to be down again today. Nifty futures pointing to a lower open, down about 1/10 of 1%. That would be a 5th or 6th day of losses, coinciding, by the way, with the gains that we're seeing in terms of Chinese stocks trading in Hong Kong. A change in sentiment, perhaps a rotation from India to China. Sensex index down about 0.3 of 1%. That's what futures are pointing to. Nifty futures also in negative territory. Again, the rupee at 83.96, unchanged versus the USD. Well, the U.S. Biosecure Act has made the pharma industry the latest sector facing Washington's national security scrutiny, putting several Chinese companies under the microscope. But this could prove to be an opportunity for Indian companies. Nandini Piramal, chairperson at Piramal Pharma, joins us for an exclusive interview. Nandini, good to have you with us. How do you see this act playing out? Might it be beneficial for Indian pharma companies?
The first thing I want to say, the act hasn't been passed yet. It was passed in the House, and it hasn't yet gone into the Senate. So I just want to be a bit measured on that. But what I do see is in the last 6 months, every single company has to have a plan B, right? All boards and management are asking, saying, what should you do if the Biosecure Act does happen? What can you need to have a plan B? So I think everyone so far has been exploring and trying to understand what is plan B. Given that moving drugs and moving both drug substance and drug product takes time. It's going to be a gradual process.
Right, but what would it mean for contract drug makers in India?
I would like to think that our customers will actually decide. They might even reshore, so they might reshore back to the US, and they might reshore, and they might outsource even to India. So I think pretty much everyone will be debating and saying what makes best sense for me. If it's a small volume, high value drug, they might even say, look, I don't want to outsource and I want to go back to the US, which is great for us because we have manufacturing in the US. We actually just announced an $80 million expansion of our sterile injectables in Lexington. But if it's large volume and sort of slightly lower value, they might, when you're talking about tons, they will look at India because India does have the capacity and the capability in order to do that.
Nandini, you talked about that $80 million expansion in the U.S., in Kentucky, to be exact. I mean, how might this contribute to your business in the U.S., and how important might that be?
So we're very excited about it because sterile injectables are an expansion area. As you look at it, some of the biggest contract manufacturers have been bought by innovative pharma. So there's been a general shortage of sterile injectable capacity in the US. So when this comes online, we think that'll benefit for those who want to keep product closer to home.
What other expansion plans might you have in the US?
We're looking at expanding in Riverview, for example. When we bought our Riverview, Michigan plant in 2016, we actually ran it, it was running like 5 days a week, one shift. We've expanded it to 7 days a week and 3 shifts. We've done one expansion, and over the next couple of years, depending on demand, we'll probably do another.
Nandini, when it comes to Indian pharmaceuticals, they've been hit by a lot of scandals, including that poisoned cough syrup, which killed dozens. Since then, regulation has been tightened. I'm just wondering whether that's enough to ensure a reversal in terms of the kind of quality products that India produces.
So as a company, we've never had a single official action indicated. We've never had a warning letter in our entire corporate history. We get audited. Our last few FDA inspections, which cover about more than 50% of our manufacturing and revenue, we've got no open observations, and we've got end of inspection reports for all of them. I think one of the benefits that we have is a very, very strong quality system. Quality reports to me. We actually work on quality as culture, not just as regulation and compliance. And it is a system of culture, people, process as well. And the other thing about us is we get audited by our customers. So last year we got audited by our customers 125 times a year. So, I mean, we've got 10 audits a month. So we pretty much have to be ready 24/7 because you always have someone coming in and auditing you. And we learn a lot from our audits. And it's a
in terms
system
of interactions with regulators, as well as inspectors, have those interactions changed?
I think the FDA is gone back to doing sort of unannounced inspections, and that's, frankly, we're ready for it because we do get audited all the time. And I think that's a good thing for raising the bar for quality.
India generic drug production is very much contingent and reliant on China APIs, the raw materials. India has talked about how it wants to move away from that reliance. Where's India with that?
I think it is still there, but for us, less than 15% of our raw materials come from China. So one of the things that we've been able to offer our customers is, as much as we can, an option that doesn't only rely on China.
But in terms of its dependence, when do you think India can cut significantly its dependence on China. What is realistic?
I think it'll be a slow process. I think we'll have to look at costs because it is a balance. If customers and regulators want lower costs, they'll have to balance that out.
Nandini, we're looking at your stock price right now. The stock has doubled in the last year. Impressive that when it comes to the PE ratio, it is more than 1,000 times. It is the priciest mid-cap pharma stock out there. Do you think at such levels it is justified? And how do you continue to build on investor value?
So I think when we talked last week, we had an investor day where we talked about how we want to double our revenue. We want to increase EBITDA to 25%, and we want to reduce debt to 1 times EBITDA. I think with all of those, I think that will help us, and we think that will create value for our investors. We plan to do it sort of by majority organically, so it is growing and expanding on the capacity and the brownfield capacity that we do have. So I do think that if we can achieve our aims, which is we will help our investors actually get returns.
So talk to us about the growth strategy. I mean, this is a company that wants to get to $2 billion in revenue by 2030. Where are you with that? And how confident are you will get there?
So last year we were close to $1 billion in FY24, and we think that it is a high confidence plan to actually get us to $2 billion. It is, as I said, primarily organic, so filling up the capacity that we do have. We also have a number of phase 3 molecules with our customers, which if even half of them actually turn commercial, I think we should see our on-patent revenue grow. Last year, our on-patent revenue was over 50% for the first time, and we think that'll benefit us.
Nandini, is there a risk out there for your business? I mean, this is a pretty uncertain environment, especially when it comes to oil prices. It continues to rise. And of course, it is one factor that is key when it comes to India's economy.
It is, I think one of the benefits of us is that we're balanced between the UK, the US, and India. So, and that helps us balance both fluctuations in foreign currency as well as to some extent, oil prices. And overall, I think we are diversified, and I think that helps us get us long-term steady shareholder returns.
Nandini, thank you so much for your time today. Nandini Piramal, chairperson at Piramal Pharma. Now let's do a check on Indian markets. Have been trading for about 3 minutes right now. Let's do a check on where they are. The Sensex index along with the Nifty under pressure, down about 0.3%. India has been under pressure for the last 1 week, coinciding with those gains that we're seeing in Chinese stocks. Rupee 83.9688. Well, plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Former New York Fed President and Bloomberg opinion columnist Bill Dudley says he's been too pessimistic about the risks of a so-called hard landing for the U.S. economy. He spoke to our colleagues Jonathan Farrow and Lisa Abramovich.
My original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a 0.5 percentage point, trigger the SOM rule. Check. But the SOM rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing, and that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question, and that's why the Fed cut 50 basis points, a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. It's still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing it all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Former Federal Reserve Bank of New York President Bill Dudley speaking with our colleagues Lisa Abramovich. Now, here are some of the other stories we're following this Friday. The union representing U.S. dock workers has agreed to suspend a strike that had disrupted port operations on the eastern and Gulf coasts. While a wage agreement has been reached, union leaders say talks on outstanding issues such as automation will continue. The union has agreed to extend the master contract with port operators until January 15th, while a new contract is negotiated. Dock workers will resume work on Friday. And now we'll look at our global rich rankings with a change near the very top. Mark Zuckerberg, now the world's second wealthiest person, jumping ahead of Amazon's Jeff Bezos and trailing only Elon Musk. The Meta CEO's net worth hit a high of $206 billion, more than $1 billion ahead of Bezos. Zuckerberg's bet on the metaverse appears to be paying off, with shares of Meta surging since posting strong second quarter sales. Now, taking a look at movies, we're taking a look at oil in particular at about $78 a barrel. Set for its biggest weekly gain since early 2023. We know that Israel is pressing ahead with its strike on Hezbollah. Biden saying the U.S. is discussing if it would support Israel attacking Iran's oil facilities, which is in contrast to some indications earlier on. Brent crude at $77.54 right now. It is headed for its biggest weekly gain since early 2023. We're also keeping an eye on the benchmark in Hong Kong extending gains after that two-day correction. Third week of gains, by the way. Worth noting, Hong Kong's market cap back above that $6 trillion mark. Hang Seng up 1.5%. H's Tag a winner right now, higher by 3.2%. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.